The after-hours market for gold is crashing, and this is for very good reason. Price continues to fall, and well, this doesn't make any sense. In fact, in times of war, gold is supposed to go up, but it just suffered one of the worst weeks in history. 1983 was as bad as we've seen, so what is actually going on here? And the truth is, a massive wealth transfer is happening behind the scenes, and smart money is moving somewhere else. What's going on? My name is Mike. I've been investing in risk on markets now for the last 10 years. I'm not a financial advisor, and this is definitely not financial advice. Let's just talk about what's going on in gold and how this relates back into risk on markets. So gold has fallen now nearly 18.5% since the whole all-time highs and the conflict in Iran. Despite these active US-Israeli emissions going on, gold simply continues to fall. And this has been caused by a giant price shock in oil. In fact, Brent crude heading over $113 a barrel. The energy spike is fueling inflation. And well, the Fed is now forced to turn hawkish on March 18th review, reducing projected 2026 rate cuts now from 2 down to just 1. And in fact, rate hikes may even be on the cards. But the safe haven of gold simply has now broken. The SPDR Gold ETFs have seen over $6 billion in assets as investors panic sell and institutions force liquidate late investors. Here's the real driver though, the strengthening US dollar and rising bond yields. When interest rates stay high, non-yielding assets like gold become incredibly expensive to hold globally. And just like we saw with silver, this is a massive positional unwinding by momentum traders, leverage ETFs. But here's the part that, well, most people are missing. This capital isn't just disappearing. Central banks are now trapped. They're trapped by rising oil prices and sticky inflation. They can't cut rates, which means monetary conditions become difficult. In fact, they become very bearish, and for traditional metals, institutions realize that if the Fed is forced to hold their rates, gold has no immediate catalyst. So if they are rotating into assets, well, the obvious signs would be there. And this would scream a giant liquidity alarm. While gold ETFs did bleed $6 billion, spot Bitcoin ETFs quietly absorbed over $1.4 billion. In fact, the largest gold-backed ETFs, GLD, saw a record $3 billion in outflows in one single day. That was as reports from JP Morgan, and that bled 2.7% of its total AUM since the Iran conflict did begin. Absolutely crazy numbers. However, Bitcoin holding strong, near 70,000 despite some macro headwinds crushing gold. These indicate a generational shift where institutional money views Bitcoin as a superior hedge. In fact, while gold is being liquidated to cover margin calls in falling equity markets, Bitcoin is being treated now as a higher conviction long trade by institutions and the banks. JP Morgan's Nicholas Perminsky explicitly noted that while capital is currently voting for Bitcoin exposure over bullion, the liquidity eventually, however, will return to the markets. And right now, the digital hedge is simply a positioned to outperform the gold markets. Now, gold and silver are facing a very incredibly stressful time because they are basically behaving like risk assets in tighter monetary environments. Meanwhile, institutional capital is quietly rotating into more risk on assets like Bitcoin as the new preferred hedge against the broken fiat system. Watching these capital flows, however, gives us an early indication as to where global markets will go next. Since the conflict began, Bitcoin has actually risen about 11.6%, currently hovering in and around that $70,000 to $73,000, while gold dropped 14% in the exact same time period. So where does this leave you, and what does it mean right now in the markets? Well, gold can no longer be a crisis hedge. It's a liquidity piggy bank. The 18.5% drop in gold isn't because people spend trust. It's because they have to sell it. The reality, while the stock market and the bonds both drop, and this is actually due to the recent spike in oil, institutional investors face margin calls. They're being liquidated on paper-handed ETFs. They sell gold because it's liquid. It's the liquid winner from the 2025 bull market. And in fact, the gold suppressed as long as the Fed stays hawkish until oil stabilizes, the war in Iran continues to come to an end. Well, there will be more forced selling, and actually gold's going to struggle to reclaim that $5,000 mark. Now remember, if you want to stay up to date with all the macro finance news, hit that subscribe button on this channel, and if you want more crypto news, then watch this video that I recorded earlier. Now, as always, make sure that you are watching all this content, staying plugged into the market, because things in this market change very, very quickly. But as always, we're going to keep you plugged in. So until next time, thanks for watching. Bye-bye.